Welcome to the Uncontested Investing Show, presented by REI Inc. magazine and sponsored by RCN Capital. Each week, we focus on bringing you candid convos from the best in the biz. Here's your host, Tim Harridge.
Welcome back to Uncontested Investing. I'm Tim Harridge. Thank you so much for swinging back by. Today, I have one of my oldest friends in the real estate investing industry, John Bowens. John, thanks for coming in.
Hey, thanks, Tim. Delighted to be here.
So a month ago, I got a little email from a podcast booking thing. It's like, John Bowens from Equity Trust. I was like, John? We were talking about it earlier. We've known each other for 10, 12 years now. But since the audience doesn't know you, just take a minute to tell a little bit about yourself.
Yeah, Tim. So it was probably 15 years ago, the first time I came across you at one of the real estate investor events. And that's when I just started getting into real estate as an investor myself. And I've been in real estate for 20 years, and I stumbled across Equity Trust back 15 years ago. And what brought me to Equity Trust, my background academically was traditional finance. So I was being groomed to be a financial advisor, wealth management consultant, go become a certified financial planner, and help people diversify their retirement savings into stocks, bonds, and mutual funds. And I was always scratching my head at that time thinking, this doesn't seem right? There's got to be a better way to do it. And all along the way, I was also working for a real estate company, a mom and pop real estate company, and I was watching them pay hundreds of thousands of dollars in taxes. They had no retirement savings accounts because they were putting all of their money back into real estate. And I thought to myself, there's got to be a better way. And it just so happened that I stumbled across Equity Trust Company, and they were much smaller at that time. This was 15 years ago. And I met the founders of the company, the Desich family, who I know you've met as well. And they taught me everything that I know about real estate investing with self-directed IRAs. And so I learned that, hey, I don't have to put my retirement savings accounts, my IRAs, my 401ks, my other retirement plans, I don't have to just put them in the stock market and hope that everything works out. I can utilize my leverage, my expertise in real estate, everything I've learned from when I was very young, and I can apply it to a retirement plan. And oh, by the way, I can go out and invest in real estate, and I can make tax-free profit. I can avoid long-term capital gains tax. So ever since then, my portfolio, my retirement savings accounts, they're not the traditional 60-40, 60% public equities, 40% fixed income securities. It's, for the most part, almost 100% real estate in my self-directed IRA, whether it's individual properties or private money loans or real estate partnerships or other direct real estate owned assets.
So hopefully everybody's paying attention, and they just heard that you're a private lender, and they start hitting you up asking for private loans.
Happens all the time.
But I don't pay taxes, and I'm not ashamed to say that on the show. And it's not because I think I'm a sovereign citizen of Rockwall County, right? It's because I take advantage of the tax code, not even the loopholes, right? I mean, to me, it's just the tax code. And I want to talk a lot about that because I think, like you just said, there's so many people that are leaving money on the table because they just don't know the other way. But first, every week, I like to start with a segment we call the bluff, the bottom line up front. So imagine someone's listening to this in their car and they're really like, I can't wait to listen to that. But then they pull over in a little bit, get gas, and you know what happens. You forget to turn it back on. I want you to take up to 2 minutes and kind of just pour into the audience the most important things you see in today's market, things you think people should be focused on, things you think people should be avoiding, or things they should be learning, or even market observations. So just kind of 2 minutes, the most important, kind of your summary of what we're going to talk about for the next 30 minutes. You good?
Yep.
Go.
So I think it's really important for investors to understand is they don't have to be at the mercy of the traditional financial market. So I talked about the 60-40 model. I like to refer to investing in alternative assets with your retirement savings accounts as modern portfolio design. For some people, it's taking 100% of their IRAs, 401ks, and other retirement plans, unlocking them from where they're at now and moving them over into a self-directed IRA so they can begin unleashing those dollars into hard real estate assets. Or for other people, it might be just a percentage of their portfolio. Maybe they want to move over 10 or 20% into a self-directed IRA. Maybe like myself, they want to be a private money lender. So lend money secured by real estate. And, Tim, I'll say that, to give you an idea of back in 2022 and how this works, in comparison to the traditional financial markets. At the end of 2022, a lot of Americans, their retirement portfolios were down anywhere between 15 to 20% invested in the public markets. All along the way, my wife and I were using our self-directed IRAs to invest in real estate. In May of 2022, we sold a property that we had owned for about 2 years in our self-directed IRAs. We made a $35,000 profit. We saved $5,000 in taxes of that $35,000 because it was all in our self-directed traditional and Roth IRA accounts. So we saved $5,000 in taxes. We made a 32% annualized cash-on-cash return. We then took that money with our other retirement savings accounts, and we made a private money loan to a real estate investor that was doing a fix and flip project. And he ended up paying us back in about 9 months, and we made about an 8.667% return. So an $8,600 profit on $100,000 deployed. And that was all while the stock market was unfortunately going down. At that time, our retirement portfolios were building, and we were saving a lot of money in taxes. So to conclude, Tim, what I would say is, for investors out there, know that you don't have to leave your retirement plans to the mercy of the stock market. You don't have to rely on a financial advisor or financial planner that, let's face it, they can only sell you certain financial products. And they're most likely not going to be able to reach into their toolbox and be able to offer you real estate or other alternative assets in your retirement plans, IRAs, 401ks, or whatever the other types of retirement savings accounts investors might have.
So that's great stuff. And for me, probably the best thing I've done in the last, I'd say, 5 years was start investing in other people's deals, right? Like multifamily syndications, commercial syndications, making private money loans. I do a lot of second liens from my IRAs to investors I know and trust, kind of gap funding. Because what I started to learn, John, was I think the game is really about equity multiples, right? Like we work really hard to make money, but I think all of us have to do a better job at making our money make money, right?
Right.
Making our money multiply. And when you let Uncle Sam or Aunt Iris take 30 to 40% of what you were going to multiply, right? A 2x becomes a 1.6x. And when you, as long as we've been doing this, that adds up.
Right.
It adds up a lot.
Right. Yeah. And Tim, it goes, I mentioned at the very beginning, academically, my upbringing was traditional finance. So it was use your IRAs, 401ks, other retirement plans, and put it into mutual funds or target date funds. And most of these funds are what I'll refer to as indexed hugging strategies. So if the stock market's going up, your retirement savings account's going up. If the stock market's going down, your retirement savings accounts are going down. That's just the reality of it, right? And that's what Americans were faced with back in the Great Recession, and then again in the pandemic, and then again in 2022. And so what I challenge myself with, I challenge a lot of the investors that I work with and that I train is, think about managing your money in a different way. Think about being your own money manager. And it's not all that difficult. A lot of people will hear about some of my stories where I've actually gone out and bought a rental property, taken care of the deferred maintenance, bought it from a motivated seller, sold it, made a $35,000 profit. There was obviously a lot more work that went into that, but there are also a number of ways in which you can passively invest your self-directed IRA funds, whether it's private money lending or investing in a real estate partnership or a privately held real estate investment trust, where you can still get the non-correlation to the traditional financial markets. You have, if you will, hard assets, hard real estate transactions in your self-directed IRA that most importantly can potentially produce better returns than what you're making in the stock market. I mean, let's face it, starting in 2000 to 2022, if you look at 2000 to 2022, if you put your money in the S&P 500, you would have made a 6.29% return on investment. If we factor in inflation, oh, by the way, we'd only have a 3.77% return on investment.
Probably less.
And it's exactly, and that's, it's numbers like that, that I studied historically, academically, and I scratched my head again. I said, wait a second, there's got to be a better way to do this.
Well, and I think, John, too many people listen to someone like you and they think it's either or, right? It's stocks or real estate. It's custodian, or what do you call it? Like if I have my money with TD Ameritrade, not a self-directed.
A brokerage account.
A brokerage account or a self-directed. And what I've learned over 20 plus years is you should not be myopic, right? You should really be open to all things. And a nice thing about a self-directed IRA, both the Roths and the traditionals, is you can still, if you want an allocation of stocks or bonds, you can still buy equities in your self-directed assets.
That's correct.
You can still buy cryptocurrency in your self-directed, right? And so people, what happens though is they start to hear us talk and they think, oh, well, I don't want to only buy real estate. I believe in diversification. And I think, for me, the beautiful thing is January of 22, I liquidated my equities accounts because the Fed started to. The minute Powell said, well, we're going to make ourselves sell all of our stocks, I'm like, yeah, I'm in the same boat with you, buddy. But, you know, then the market was down, I think, index-wise, 27% by October. And I wasn't. But instead of letting that money sit there, I had the option of using it for other things, right? I had the option to make a private, well, just say that you said. I had the option to go make a private money loan. I had the option to invest in a multifamily syndication. I had the option to get into a commercial deal. And by the way, the triple net commercial deals that I'm in, like that's the best performing asset I've had in the last 18 months. So I think that's a very key part of this that people need to understand. And I'd like you to talk about, because self-directed IRAs, the first thing people say is that, well, there's no rule book, right? There's not a list of allowed things. There's a list of disallowed things, right?
That's right.
And so could you talk a little bit in broad terms what all a self-directed IRA can be used for?
Yeah, so a self-directed IRA can be used for just about any type of asset. Now, you'll hear me use that term alternative investment. When I say that, just think non-stock market-based investment. Now, we talk a lot about real estate. We talk a lot about private money lending. I've given some examples of that, real estate partnerships, but it goes beyond that. You could use your self-directed IRA to invest in cryptocurrency, for example. With a firm like Equity Trust, we actually allow our customers to diversify in real estate, in cryptocurrency, in physical gold and silver. Some people are using their IRAs as a hedge against inflation, investing in gold and silver. You have the capability of owning the hard asset, not owning an ETF, right, that's tied to silver or gold, but actually owning the physical asset stored at a depository. Also investing in private equity or hedge fund related investments, venture capital, or a startup business type opportunity. All of those are options available to Americans with their retirement plans, and it all started back in 1974. Back in 1974, the Employee Retirement Income Securities Act was passed. And out of that act gave birth to IRAs, 401ks, and other retirement plans. And when the law was created, the government was exclusive rather than being inclusive. Coincidentally, our company was founded by Dick Dessich back in 1974. And so pretty quickly, people began to catch on to this fact that, hey, I'm looking at the tax code, I'm leveraging what the law allows us to do, and I don't have to keep my money in mutual funds or individual stocks or a bond fund. I don't have to put it with a financial advisor. I can actually invest in real estate. Now, in terms of what you can't do, so the government only tells us what we can't do, not what we can do. You can't invest in assets like collectibles. So I always like artwork, for example. I always like to say, you know, the things that you wouldn't want to invest in anyways, from an investment perspective, is what you can't invest in with your IRA. And that's about this much. And then there's this massive world of alternative investments, including real estate. The other thing you can't do is invest with certain individuals known as disqualified persons. So the tax code 4975, specifically, if anybody's interested in light reading, they can check that out. There's
Not
specific
my audience,
yeah.
John.
So I'll fast forward through that bit. But, you know, there's certain people that you can't transact with. So, for example, if I own a rental property now, I can't use my IRA funds and buy that rental property for myself. If I have a rental property in an LLC, limited liability company, I can't use my IRA and buy that asset for myself. I can't loan money to my children. I can't buy a property and lease it out to my son or daughter and their college buddies. Those are what are known as prohibited transactions. And like I said before, you know, usually it's the transactions that you wouldn't want to do anyways, right? Transactions with your family, artwork, collectibles, life insurance policies. You know, those are transactions that you can't do, but there's this massive world of non-stock market-based investments. And you can get incredibly creative in the venture capital space, in the startup business space, even things non-real estate related. I worked with a retired surgeon. He spent his entire career working with surgical equipment, and he had a very specific expertise. He went to lots of conferences about this topic. And so naturally, when he retired, he wanted to sort of stay in the game, so to speak. And so he began venture capital investing. So he began investing in small startup surgical companies that were developing proofs of concept and then selling those businesses, exiting those businesses to like a big Medtronics. So it was proof of concept, patent, go through the whole protocol, and then sell the business. And he was doing this all in his Roth IRA, Tim. So for viewers out there, really important for them to know that a Roth IRA, you seed the account with after-tax dollars, and then it grows 100% tax-free. And so as long as you follow all the rules and all the guidelines, all of your distributions are 100% tax-free. I worked with a couple that grew their retirement plan from about $200,000 in 2010, after they were, as they call, stock market refugees, to over $1 million in properties and over $130,000 in net tax-free cash flow on an annual basis. So every year they can take $130,000 out of their account and they pay 0% tax. Or they can leave it to their children or their grandchildren, and their children or grandchildren pay 0% tax. So the Roth IRA, I can't stress enough how powerful of an estate planning or legacy planning tool that can be, whether buying houses, rentals, fix and flip, private money lending, real estate partnerships, whatever it is that an investor may be looking to pursue.
Well, and I think people hear 130,000, and what they don't understand is today's equivalent, that's probably 160 to 170 of gross income before tax, right?
That's right.
But looking at, like, even if you're out there and you're new and you're thinking, well, I'd love to make 130. Well, if you believe in yourself, one day you will, right? And then one day you'll make 200, one day you'll make 300, one day you'll make 400. And if you look at the I would say, trajectory of tax percentages in this nation, 130,000 with no tax may be the equivalent to 250, 260,000 soon before tax, right?
That's right.
So I think it's, with the way Jennifer and I look at it, it's also a hedge against society.
Yes.
Because I feel like our nation's becoming a bit of a, I don't want you to have something if I don't have it kind of place. And I love America. I'm a devout patriot. But when you look at what's happening with the tax code and the war on wealth, I feel like we almost owe it to the next generation to insulate that from that.
Yeah.
Does that make sense?
Yeah, and Tim, our beliefs are the same. Here's the way I look at it, and this is why I so passionately, every year I fully fund Roth IRA for my spouse, our Roth 401ks. So there are different account types. There are IRAs, there are 401ks, and especially for small business owners, for anyone that's out there that is an entrepreneur, you're a business owner, you could look at an IRA and what's known as a solo 401k, and there's they call a Roth component. And if you're structuring things properly and you have the right amount of income, you could potentially get well over $60,000 into retirement accounts in one individual year, just through contributions. That doesn't even take into account the investments you do. Like when I bought a property in 2020 and sold it in 2022 and made $35,000 tax-free, for example. And so, I spent a lot of time focusing on funding those accounts, getting as much money into the Roth accounts, because here's the way I look at it from what you were saying, Tim, is it's a hedge against inflation for me. It's a hedge against pending increases in taxes. The way I look at it is when I'm in
so much better than me. And I said a hedge against society, and you said a hedge against pending increases in taxes.
I tend to
we go to John's version of that. I'm sorry. Go ahead.
No, that's okay. I tend to clean things up a little bit, but so a hedge against inflation, hedge against future taxes. And here's the other thing with IRAs is I like to call it predator and creditor protection. So there are certain creditor protections that I have with my IRA funds. And that's really, really important. If something happens unforeseen, right, I know that I have those retirement plans there. And oh, by the way, my IRAs also avoid probate. So if I'm someone that, let's say, doesn't have a structured trust in the way that is going to optimize that so I don't leave a burden to my children or grandchildren or other loved ones, that's okay. The IRA has sort of a trust built in it and has some unique intrinsic estate planning benefits to it. And unfortunately, Americans don't know about a lot of this stuff, that their financial advisors and planners don't always talk to them about this. I'll give you an example, Tim. My father was selecting financial advisors, interviewing financial advisors about 2 years before he was about to retire. And so he said, John, can you help me with this process? So, my father worked very, very hard his entire life, and but wasn't someone, like myself that, went and studied finance and investments and things of that nature, but built up a nice nest egg. And so now he's at the point of, how do I preserve this nest egg? And so he's 2 years away from retirement, and he's interviewing financial advisors, and he has this financial advisor call me. And so I start talking to this gentleman, and I say, okay, well, I'm going to increase my father's contributions to his 401ks so he maxes them out because he's only got 2 years left, and he can get some rather high tax deductions for that. And in 2 years from now, he's not going to be able to contribute to his 401k anymore. And the financial advisor kind of looked at me dumbfounded, like, well, why would you do that? He might need that money. I'm like, he doesn't need the money. All the kids are out of the house. He's in the highest earning years of his life. Now is the time to max out those accounts. And this was his financial advisor. Right. And the reality is, and I'm not disparaging financial advisors and planners, because there's a lot of them that are very good at what they do. But just like anything else, just like real estate, there are good realtors and bad realtors, right? There are good borrowers of funds and bad borrowers of funds, being in the private money lending world. And so unfortunately, I find all too often that these financial advisors and planners don't always think about these types of things and provide the appropriate guidance. They only have certain financial products that they can sell an individual, and that's all they're going to talk about. They're not going to talk about these types of things. So, I can't encourage folks enough to, really do due diligence and, start taking control of their retirement plans and looking at the types of investments that are going to make the most sense to them. Because the reality is these IRAs hedge against inflation and taxation, to take it back there. I call it compounding interest in the absence of taxation. So if I'm eliminating the variable of taxation, what I'm effectively doing is increasing my yield. And if I can increase my yield on an annual basis, I can get to my retirement goals and my financial goals in a shorter period of time.
So I normally save rapid fire for the end of the episode, but we're actually going to do it in the middle section because I have a lot of questions, and I want to just pick your brain as much as possible. But first, we're going to take a break, okay? So stick around. We'll be right back.
Are you looking for fast funding for your next fix and flip? What about leverage for your next long-term rental or vacation rental? Need capital for a new construction project? Look no further. RCN Capital has you covered. As the leading nationwide lender for real estate investors, RCN Capital offers short-term and long-term financing solutions for your next investment property. RCN Capital takes a common-sense approach to your loan request, offering high leverages and low rates backed by superior customer service. Whether you're investing in single-family properties or multifamily properties across the U.S., RCN Capital has funding options for you with no hoops to jump through and quick closings in as little as 2 weeks. Ready to get a quote for your next investment property? Visit rcncapital.com/podcast to apply today. There is no fee to apply. Again, that's rcncapital.com/podcast to apply today.
Welcome back to Uncontested Investing. I'm Tim Harris. Thank you for sticking around. I'm still here with John Bowens. John, you were in 40 or 50 episodes. I don't even know how many we've done, or probably 30. You're the first time I've taken the first segment that long, and I'm completely off script, but it's because this is so important to me. Because I'm someone that comes really from nothing, right? And I've been very fortunate to make what I've made and earn what I've earned. And I've learned, you just mentioned before that break, compounding interest in the absence of taxation. And compounding is something I've really been focused on, I'd say, the last 12 months. Compounding my time, compounding my equity, compounding my interest. And and I think it's that value of hindsight. 22 years later, you look back and, oh my God, I bought that house for 80 grand. It's worth 350, right? And you start really analyzing people say all the time, what's the best advice you have, Tim? I'm like, one more. Just keep one more house a year. 20 years goes by a long time, and there's going to come a time where my children and your children are talking about, can you believe my dad used to buy these houses for less than $1 million? Right. It's coming. Like, I mean, house I grew up in, my parents bought for $18,000. Now it's worth $350,000. And there was a point where like, oh, over 100, you're crazy. Oh, over 200, you're crazy. Oh, over 300, that's a good deal. Like, you know, it's like people's relationship to money changes. So I want to start IRA only, traditional IRA. In 30 to 60 seconds, tell me what a traditional IRA is and how much I can put into that every year.
So a traditional IRA is known as a tax-deferred IRA, meaning when you make contributions, you get a tax deduction. It grows tax-deferred, so you eliminate capital gains tax, ordinary income taxes in every year. That's the benefit. But then when you start taking money out after 59 and a half, that's when you have to pay taxes. So we always say you either pay taxes on the seed or on the crop. Contributions for tax year 2023, you can contribute up to $6,500 when you're under the age of 50. There's a $1,000 catch-up contribution, which would get you to $7,500 for those that are 50 and over. And always know that if you have a spouse, even if they're not working, as long as one of you has earned income and you're married filing jointly, both of you can contribute to your IRAs. And that's an important one because a lot of people fail to do that.
Can I do that? Can my children have a traditional, can they? Not should they? Can my children have a traditional that I contribute to as well?
Yeah, actually, in fact, to make it a little bit better, the Roth IRA would likely be...
Roth next. Traditional.
They can. Okay. Usually that's not the way folks do it. But
so anything else about traditional IRAs we should mention?
No.
All right. So that's going to be a good reel, right? John, Roth IRAs. I would like to know how many I can have. I'd like to know how much money I can put in. And if I'm married with 2 children, what can I do? How much can I put where? In 2023.
So with a Roth IRA, you can have as many Roth IRAs as you want, but you can't exceed a certain dollar contribution on an annual basis. So for 2023, you cannot exceed $6,500 when you're under the age of 50. When you're 50 and over, there's what's called a $1,000 catch-up contribution. Will get you up to $7,500. Now, that could be for you and a spouse, even if they're not working, as long as you're married filing. As far as children are concerned, as long as the children have earned income, they can also have Roth IRAs and be funding with contributions up to $6,500. And all of the profits grow tax-free. And some people ask me, well, what if I only have a small amount of money in a Roth IRA? Well, think about this, Tim. I know that you know how to find deals. You know how to find good real estate deals. I learned about them in your workshops 15 years ago when we met each other. And so let's say you found a good real estate deal and you only had, let's say, $6,500 in your Roth IRA.
Partner up. I don't want to go there. If my, I need to stay focused here. So if my kid doesn't make $6,500 a year, say he works at Chick-fil-A, can he contribute $6,500?
He cannot. He's got to have the $6,500.
So the contribution cannot exceed the earned income unless it's the spouse and the married filing jointly type thing. The other spouse has enough earned income to cover it.
That is correct.
All right, so that's the Roth IRAs. John, earlier in the show, you mentioned Roth IRAs, you mentioned traditional IRAs, and you talked about a 401k, solo
401k.
So could you tell me what that is, the contribution limits, etc.?
Yep. So solo 401ks are for self-employed individuals who don't have any employees. 1099 contractors are 1099 contractors, but you can't have any W-2 employees with the exception of a spouse. Think of a solo 401k just like a 401k with a company you would work for. You make a contribution as an employee, and then there's an employer, what is known as profit sharing deferral. So how much can you contribute to a solo 401k? Well, if you have enough earned income, you can actually contribute up to $66,000 in 2023 when you're under the age of 50. Yeah, when you're 50 and over, you can get up to $73,500. And with some unique structuring and strategies, as long as you're working with the right company. So for example, Equity Trust, we administer solo 401ks, and we can help people make their contribution and actually convert everything over into a Roth bucket, which means they can get upwards of $66,000 or $73,500 for people that are 50 and over. And then they grow that account 100% tax-free for the rest of their life. They'll never pay taxes again.
And when I put it into the 401k, is that pre-tax or post-tax?
It could be either one. You could do pre-tax and get
that's the bucket.
Those are the buckets. You get 2 buckets with a solo 401k.
So if I own a S corp and I'm the only person, and I pay myself $66,000 out of it, I can go ahead and put $66,000 into this solo 401k.
So there's the employer deferral, which you're going to be limited to 20% of your self-employment income, or if you're set up like an S corp with a W-2, it'd be 25%. So for all intents and purposes, you'd have to be paying yourself over $200,000. That would be earned income, meaning income that you're paying Medicare, Social Security tax on, ordinary income taxes, right? So you got to pay your taxes on a substantial amount of income. But if you're paying yourself a substantial amount of income, you can get that full $66,000 or $73,500 into the account.
Okay. What other types of self-directed accounts are there?
So there's also a SEP IRA or simple IRA. With the solo 401k, we find that to be sort of the superior business retirement plan. But some people, as a self-employed individual, would select a SEP or a simple IRA. Beyond that, you have 2 account types that aren't in the retirement realm, but they are tax advantage, tax efficient accounts. The first is the health savings account. So a lot of people don't know that if they have a high deductible healthcare plan and they have an HSA, or they don't have an HSA but they qualify, they can open up an HSA plan, make a contribution, get a deduction, grow it tax-free, and then when they take it out, they don't pay any taxes, so as long as they use it for healthcare-related expenses. And you can self-direct that HSA into real estate. You can buy houses. You can partner with your other IRAs on a private money loan. There's all different ways you can grow an HSA. And then last but not least, for children or grandchildren, you have what's known as a Coverdell Education Savings Account. And so you can put money in there like a Roth IRA after tax. It grows tax-free. You take it out, you pay 0% tax. So as long as you're using it for educational expenses, whether it's K through 12 or even higher education. I have a guy that bought land, $8,000 piece of land in Tennessee with his 3 children's Coverdell Education Savings accounts. So you can actually partner multiple IRAs and investment accounts together. He ended up selling it for about $60,000 60 days later to a developer, made $50,000 tax-free for his children's education in those Coverdell accounts.
So partnering up is one of those things that I've looked at a lot. I think it's just powerful. I've raised some private funds where the minimum investment was $50,000, and it was through Equity Trust. We got an exemption where the investor, but not an exemption, I don't know. We had to fill out your paperwork. He did the $50,000 investment, but it was in 3 different IRAs. Like he had to break it up somehow. And as the fund manager, I had to sign something for you.
Happens all the time. Yep.
You guys are not, I'm a customer and I also have funds that come from Equity Trust. I tell you, you're nicer to the customers than you are the fund managers. There's a lot more paperwork as a fund manager than there is as a customer, which is good, right? Like, because if I'm doing all of this, trying to be a good steward, an intentional steward of money, trying to grow my family's net worth and the future value of my children's lives, I don't want to make one of those mistakes you talk about that end up disqualifying. And anytime Uncle Sam or Aunt Iris start poking through things, it seems to be a problem for me.
Right. having clean paper, and that's part of our duties as a custodian, is to collect the documentation, work with the client, in some cases work with a fund manager, and be able to go through that process and make it a smooth transition for our client and the fund manager. And technology over the last 15 years has really advanced to make that very, very easy for our customers, where they can log into a portal and seamlessly process their transactions. But as far as partnering is concerned, you're absolutely right, Tim. Very powerful, especially for those that maybe don't have enough money in their IRA. So you can partner, let's say you and I partner together, you found a deal, and I funded it with my IRA as a partnership with your Roth IRA that maybe only puts $7,000, $7,500 into the deal. But maybe we negotiate, because you found the deal, that you get 50% of the net profits. I had a guy do this out of Milwaukee, Wisconsin, only had $24,000 in his Roth, wanted to go out and take down a $224,000 deal. Partnered with another Equity Trust investor. They brought in about $200,000. They took down the deal. He sold it. He made $42,000 tax-free in his Roth IRA, and then paid the third-party investor about an 18% annualized return. You can partner your family members' IRAs together. When I do private money loans, I'll actually partner my traditional and my Roth together. The last loan I did was a $100,000 loan to a real estate flipper in 2022, and it was 35% my traditional, and then the remaining 65% my Roth. And you know why I used my Roth at 65%? Because I wanted to max out as much Roth dollars in that deal as possible, because my return, which is about $8,600 in profit, more of that flowed back into the Roth. Most importantly, it was tax-free. So if you do a loan outside of your IRA, you're going to pay ordinary income taxes on the interest because it's interest income. Instead, you do it in an IRA and it's tax-free.
If I have two Roths, is the total contribution limited to $6,500, or is it $6,500 per?
It's across all your IRAs. It's going to be $6,500 when you're under 50, $7,500 when you're 50 and over. But earnings, so if I grow the account, if I go out and do a real estate joint venture, like I mentioned, you're not going to be limited.
So why, I'm going way over, and I don't care. Why can I defer, like in a employee 401k, it's like $22,000 or something this year?
That's right, $22,500 when you're under 50.
So why is it more if I'm an employee for someone, or if someone else is managing that money versus if I'm managing that money?
That's a great question.
If you don't want to answer it, it's fine.
Well, obviously there's the theory behind that is Americans are only going to be able to get so much in tax deductions, right? And so I believe the theory behind that was we can't allow people to contribute too much to their IRAs because then it's going to make an unbalanced budget, right? There was, by the way, a recent piece of legislation known as the Secure Act 2.0. And any of your subscribers, we actually have a video on YouTube. If they're interested in going to the Equity Trust Company channel on YouTube, I have a video all in the Secure Act 2.0. And we talk about how this legislation will allow for higher contributions in future years for Americans. So there's actually a lot of positive that came out of that legislation.
Well, I want to see that. So if I'm an employee for RCN Capital, I can do $22,000, whatever.
500.
And if I have an Equity Trust IRA, I can do an additional $6,500, or?
That's correct, yeah.
Okay, so even if I'm an employee of a company and I'm out there thinking about real estate, what I hear you saying is I can still utilize all of, like, I can take advantage of my employer match and all that over here, but then I can still start this other thing now too.
That's correct.
And that's additional contribution. So I got 22.5 over here is in Tim Heritage, the employee of RCN Capital. And then I can do another up to $7,500 because I'm under 50. No, $6,500 because I'm under 50.
Right.
Per year, spread across different IRAs and 401ks.
Right.
And I've been listening to this for 50 minutes. I'm thoroughly confused. How can John Bowens and Equity Trust help me understand what my options are?
Yeah, so real easy. Anyone can reach out to Equity Trust. We have over 400 associates. We have over $40 billion in assets under custody and administration. So we do thousands of transactions on a weekly basis for investors buying real estate, investing other alternative assets. And so anyone can reach out to us directly and speak to one of our associates. I always let people know we don't sell investment products. So we're not going to solicit investments to individuals when they reach out to us. And I find that when individuals find that out, they're much more interested in reaching out and talking to our associates because they know that we're not going to sell them something that might not be beneficial to them. We're going to educate them on how a self-directed IRA works. Now, if someone wants to get more educated on their own, do research, they can go to our website, trustetc.com. They can also go to our YouTube page. So you just go to YouTube and search Equity Trust Company. I have all types of videos on all different types of topics, a lot of what we talked about today to really drill down into, okay, how does this work and how can this work for me?
I think if you're out there listening and this is interesting to you, number one, I can personally vouch for John and Equity Trust because not only do I trust them with my money, I've trusted them with friendship and guidance for a pretty long time. And y'all just got a ton of resources in the portals and the forums and the YouTube videos. So I think if you're out there listening and you feel like you need more information, you would benefit from getting on the phone with someone from John's team and checking out the YouTube videos, because I feel like we all have an obligation. It's it's beyond opportunity for me at this point. I feel like we have an obligation to take care of future generations and to be good stewards of what we have. And
That's right.
And I feel like this is one of the more important ways that we can do it. So
Yeah, and Tim, I did a lot of the education that I've created over the years was out of anger and frustration, because when I got into the business 15 years ago, there was nothing, very little. Our company founders did a lot of training on the road at different expos and things of that nature, but there wasn't any sort of central location where people could learn digitally. And so that's what we've created over the years so that people can consume the content, they can learn, and most importantly, they can accelerate the learning curve. Because the first thing that I hear from a lot of people that reach out to us, and my teams that manage talking to customers on a daily basis, we call them IRA educators or IRA counselors. One of the first things that a lot of people will say is, hey, I've been investing in real estate and I've been paying a lot of money in taxes and I heard about this, but I just never took the time to really explore it. And I wish I would have done it 10 years ago because all of that compounding interest in the absence of taxation. But, the reality is, we can't go back in time, but we can help accelerate the learning curve so that folks can kind of get from point A to point B in a quicker path.
Exactly. So we're out of time. Do you have any parting thoughts or parting shots?
I just encourage investors to, like we said, get educated on these topics. And don't be fearful of a self-directed IRA. I will caution that there are a lot of folks out there that are fear mongers in this space. And some of that is perpetrated by your advisors and planners and sometimes CPAs that aren't educated on the topic of self-direction, or they may not have a financial incentive to teach someone about self-directing into real estate. And we have some video training specifically for CPAs and advisors so that they can learn more about this. And some clients, their advisors are actually very friendly to this idea because the advisor knows that, okay, if I help this investor to a certain extent, they might leave some of their money with me. If I don't help them, I'm going to take it all. And I've seen that countless numbers of times where investors reach out to their advisor, they don't get favorable guidance, and they end up taking everything when they initially were only intending on taking a small percentage.
And, I argue with property managers all the time right now because they want to talk people into using a manager by scaring them into it. Oh, what are you going to do when the tenant calls you at midnight with a broken toilet? I'm like, yeah, nobody ever does that. Because if you clog a toilet in the middle of the night, you can just leave it for someone else to find in the morning, right? Like, it's just, but like fear-based tactics, I would never do business with anyone that tries to do that. But I completely agree. It's not about what you've done up to this point. It's about what you do after this point.
Right.
And so, man, I appreciate it. So trustetc.com, Equity Trust Company on the YouTube channel. We'll put all that in the show links. Any phone numbers or email addresses or anything you want to give before we go?
Yeah.
Not yours personally, clearly.
Oh, yeah. Yeah. Our number, real easy. Find us 888-382-4727 or go to the website, trustetc.com. Our phone number's there. We have agents there available Monday through Friday. Folks can also go online and schedule a specific appointment that's going to work good for them and maybe their spouse.
Yeah.
We encourage investors to also have their spouse involved in those conversations if that's important to them, just to make sure that everybody's on the same page as far as what they're trying to accomplish.
Trust me, as someone that's made decisions with the retirement money without running it by their spouse, get your spouse on the phone. Very important, very important. Well, man, thank you so much for flying in. I truly appreciate it.
Yeah, thank you, Tim.
And that is it. We are out of time. This has been a completely different episode, but one that I think is very important to you. So thanks for stopping by. Remember, your network is your net worth, and today you've been growing both. We'll see you next week.
Thank you for listening to Uncontested Investing. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow REI Inc. magazine on LinkedIn and Facebook and RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time.